Now you need 12% for broker fees. You need 10% in maintenance fees, and 2% in property taxes every year.
Yeah, those numbers don't make sense. No, absolutely not. I understand where he's getting at. Maybe Mr. Cardone is trying to get you to not buy real estate so the property drops so he can buy it off you, right? Think about that, right?
Realtor Association of the world saying renting is throwing away money.
We say that because it's true. Remember, when you're renting, 100% you're paying interest to the landlord. That's why we're saying you're throwing away money. But yeah, let's see what this guy goes on to say. Welcome, everybody. It's David Chinelli with another episode of DC Talks Podcast. This is episode 99. And for the 99th episode, Wayne Gretzky, we wanted to do something a little bit different. So Owen has sent me about 3 videos based on real estate, which he thought were pretty interesting. He wants to see my reaction to it. And so that's what we'll record today. So without further ado, I guess, let's just get right into it. Let's get to the first video. So the first video I just see over here, I don't know if I'm going to like this. It's called, is it cheaper to rent versus buy? All right, let's see what happens.
Owning a house and buying a house and taking out a mortgage and taking on debt ain't all that it's cracked up to be. The Realtor Association of the world has done a great job of saying renting is throwing away money.
We say that because it's true. I've said this to my clients, and like, if you're renting for a long period of time, remember, when you're renting, 100% you're paying interest to the landlord. You know, like, talk about interest rates on your mortgage rates. You got to remember, everything you're paying off a mortgage to somebody else. So it's 100% interest. So that's why we're saying you're throwing away money. But yeah, let's see what this guy goes on to say. I can already see what this is leading to. Anyway.
Because that's what the American dream was 50 years ago. Yeah. Buy a house, 2-car garage, picket fence, 2.2 kids. That's what the American dream is. The American dream today is economic freedom. Pick and choose wherever the hell you want to go.
Economic freedom. Where do you think most people have got their economic freedom from? Real estate. Like, if you look at all billionaires, they all own real estate. So be careful, buddy. Like, the average Joe you're talking about, how much economic freedom do they really have?
Keep it moving and stay flexible and keep your overhead low. So what people forget is that, all right, you know that if you're going to buy a place, first thing you're going to look at is the mortgage payment, right? So typically, I mean, the last 6 months, it's gone from 3% to 6%. That's double. I'm not a mathematician, but I'm pretty sure 3 to 6 is double. Good. But the 3 things that people forget about when they go to buy a house, and for those of us that have bought a house, they get it now.
Buddy, when you're getting a mortgage, those come into effect. Like, don't tell me you don't think about those things. You go to a broker when you're getting a mortgage. Those are 3 big things they always use to calculate. And if your interest rates are increasing, go from 3 to 6%, chances are, like what's happening in our economy right now, prices are also dropping. So when you were back in 2021, you're paying $1.3 million for a property on average. Now you're paying 1.1. So sure, your interest rates might have gone up from 3 to 6%. But think about it, your payments have gone less because you're paying $200,000 less. Are you not taking that into consideration?
Those of us that have not is what I call the big 3 expenses. That's your taxes, your maintenance, and your insurance. Those are 3.
He's also saying you don't have to pay for maintenance fees, taxes, and what was the other thing? The third thing on you don't have to pay for those. What do you think is part of your rent? Do you think a landlord is not calculating that as part of his cash flow? Oh man, I think this guy needs a little lesson in how to being a landlord or a tenant or buying a house. I'm sorry, I don't think, this guy's got no credibility whatsoever. So I always say the biggest financial, I would say, factors that comes in whether you're looking to buy or rent is like, how long are you going to be in this neighborhood? Do you know the neighborhood? Like, why are you buying versus renting? I am not opposed to people renting. And here's one I think that people should rent. One, what your economics position is not great. Maybe you have to build on your credit. Maybe you have to build, like, some people do still have to build on their deposit, so they don't have that amount of money. So economic situation matters. Maybe you don't have a full-time job. You're not secure. Maybe you're looking to get married or something that happens. Or maybe you're just in a new country or you move different cities and you're not sure of a particular area. But when you're living in the same spot for 10 plus years, you know the neighborhood, I'm sorry, at that point, you've thrown away a great opportunity to purchase. So yeah, there's a lot of factors as opposed to renting versus buying.
Here are some of the worst houses to buy as a long-term investment property. Here's an example of a property here that is way too nice and is also in a very expensive neighborhood. So in order to cash flow, you usually have to put down 50% or more to cash flow in a very expensive neighborhood. Here's an example of a property.
Yeah, I kind of agree with that, right? Like, But again, an investment property is a different animal than it is for your own home, right? You want to look in areas. It's very different when you're looking for a property to rent, because things don't matter as much as you're renting, or sorry, it matters different to renters as it is to buyers, right? So renters want to be closer to major highways and streets and all that, and subways, where a long time, like when you're looking for your end home, you want to keep it quiet, a nice backyard. Very, very different factors. So yeah, I would agree with that 100%. Like the nicest street, all that stuff doesn't matter as an investment property. You want to see the numbers and where it comes from, because you're not going to rent out a home that is that much that nice as opposed to your neighbor, which is kind of crappy. You're not going to get much more money for it for rent. Agree with that.
Put it here that's still relatively very nice still, but it's in the area you got that's actually the price point very lower. And in this area, the rent is also very low. So in order for it to cash flow, you're gonna need probably 35% and more. Here's another example of a property in relatively good condition.
I actually like this guy compared to me. I would agree with that too. So when you're looking for an investment property, sure, the property might be lower, but you also have to factor in what the rents are. It's part of the cap rate, what you're looking for. He's 100% accurate. If you get a really shitty property in a nice area, but you can add value by, sprucing up and not put a ton of money, but just, put a little bit of lipstick on it big, you will get higher rents if the rents are higher. So that's what we're talking about earlier. Area does matter. It does, especially where it's located. So I would agree with him on that one as well.
And is in an average neighborhood, but you can't add no value to this because look, usually people add ADU on their land. Well, there's no more land to this property, so you can't add any more value. So this is why this deal is not a good deal either.
He just emphasize exactly what I said, right? If you buy a shittier property, you can add your own value. A lot of times investors are looking for a house they can add a little bit of elbow grease in there too. They can knock down the price a little bit. And again, you don't have to break the bank to do it, to make it look nice and rent it out. So yeah, I would agree with him. So far, first video versus second video, very different responses so far. So yeah, I would 100% agree with this guy. I don't know where you found him, but I would agree. I think this guy's a good investor. If you want to follow him, I would say, yeah, go ahead. So yeah, also it matters, when you are looking to rent, you also got to look at the number of units. I personally don't think buying a house as a single family dwelling is a good investment. If the single family dwelling is able to put a basement apartment, or you're add like another 2 or 3 units, that same house, if it has 2 or 3 units versus like a single family home, the 3 units will earn much more money, better cash flow than the single family dwelling. The other thing I want to add to that as well is, like, if you have 3 units here, you can renovate one unit, have one vacant, and the other 2 can help carry the property. Whereas if you have just one home and there's nobody living in there, you're going to have to front that cost for it being vacant until it rents out. So the risk is much higher for a single family dwelling. But what you can also look for is, if you have a realtor too, like when you're looking through these properties, seeing if there is opportunities to add second or third unit. I do like bungalows that have a separate entrance and they already have hookups close to, electrical units, so you can add stove, hood fan, and they already have like a full bathroom downstairs. It's much easier to convert that into a basement apartment, and you'd be surprised at how much rent that'll rent for. And if it's a legal apartment, even rents for more. But here in Toronto, did you know over 90% of basement apartments are illegal? So don't let that scare you away from purchasing a property if you're worried about it being an illegal unit. So are there attributes in the area you should be shying away from? Obviously, you want to stay away from areas that have a lot of violence, and they're always in the media. Even if they're adjacent to that area, be careful. So everybody knows how bad Jane and Finch is. Like, even if you're at Jane just past Finch, people are going to be leery about purchasing. So rents will be much lower because they're scared about that. That's a huge factor. And that also plays into you also want to get in almost a recession-proof type of area. So if you're close to the subway line, and if there was, let's call it a recession, what happens in those areas, believe it or not, is when the rest of the housing market kind of goes down, those areas still hold their value. So if you're looking for a rental property, you want to have a property that has good access in good areas that are close to subways, they're close to parks. You want to, again, anything that a renter's looking for, it's easy, convenience. Those are more recession-proof areas. So look at the economics of the area, of where the downturn was. And how did that area perform? Remember, when we give you an economic analysis every single month and we tell you how, the treble, what's happening in the markets, we give you the GTA numbers. But from those GTA numbers, we can go down to Toronto, Markham, Brampton, etc. And then from there, we can go from areas. And then from those areas, we can go to communities. So my suggestion for you is if you're debating between a couple of areas you don't know very well, look at when the market has dipped. Where did those prices go? When the market was high, where were those market? And what's the delta between those two? What you're looking for is a small delta, right? A change, a fluctuation. You don't want to have huge fluctuations in prices. That means it's more of a stable market and it can withstand any downturns in the market. So the best way to find out if a house needs a lot of costly repairs, you need to do a home inspection, right? And after you do a home inspection, also maybe bring a contractor with you as well to give you real numbers behind it. Now, somebody like myself, I've done renovations too, but I still talk to my contractor to say, hey, am I still right with these numbers? A good realtor would know relatively cost of certain things, but it's always good to have a contractor. Your realtor should have a couple of contractors they can bring with you as well. So before you firm up a deal, and you have a deal that's conditional, make sure it's conditional upon financing and conditional upon home inspection. The reason why I say both of those is because you got to know after the home inspection how much money is going to cost you to fix this property and if that number plays into your financing. Because anybody can get a mortgage nowadays, right? I can charge you 100% interest, and if you don't pay, I can get a couple of my cousins that are with the baseball bats to beat you up and come after the money. You're going to go bankrupt in a month. Does that make sense? Absolutely not. But we want to make sure you can afford this property, and we also want to make sure that you can afford the repairs. So those are two things whenever you're putting an offer, especially on a property you're not really too sure about, in the sense that because it might be your first investment property, you're getting new into this, and you don't have a lot of money to throw away learning, make sure you have those conditions. All right, and for our last video,
buying a house, worst investment you'll ever make in your entire life. Let's say you paid $1 million to buy a house. Average house here is $576. $576 is what you paid. Now you need 12% for broker fees. Let's say you keep the house 10 years. You need
first of all, our market is very different in the States. So, I take this with the greatest salt. I've seen this video before and I don't agree with them. But anyway, go ahead, Grant.
10% in maintenance fees. It's 1% a year in maintenance fees. It's about 2% in property taxes every year. That's 20%. 2 times 10 is 20. And it's probably 7% to the bank, so that's 70%. Total those up, it's 112%. $576,000 home will have to be sold for $1.2 million in 10 years.
Yeah, those numbers don't make sense. No, I'm sorry. Absolutely not. Listen, take out a calculator. I'm doing this here. I would revisit this property and no. I understand where he's getting at, right? Again, you got to remember most people, especially here in Toronto and Canada, and made most of their wealth, and in the States too, through real estate. So maybe Mr. Cardone is trying to get you to not buy real estate so the property drops so he can buy it off you, right? Think about that, right? There's a reason why BlackRock is going around buying all the houses, right? They see the value in the land. So I don't think this number is actually accurate. What you do need to figure out is, remember, when you're purchasing the product, how much money, again, take those factors in, the taxes, et cetera, throughout the year. But you also got to take appreciation. So yeah, for $1.2 million in that short period of time, that's kind of crazy. But I don't agree with those numbers at all. But you also remember that equity builds, right? When you're purchasing a property, now the numbers are changing. As of December 15th here in Canada, you don't have to put $1 million. You don't have to put 20% down if you're purchasing a property over $1 million. Now it gets pushed to 1.5. You're purchasing a property over $1.5 million. Yeah, you need 20% down. So you got to remember, so let's call it, you're buying a property for $1 million. You only have to put 10% down. Sure, and you get assured mortgage. They add that to the value of the cost, and you have to pay HST. But remember, you're putting 10% down on a property worth $1 million. So let's call that $100,000. Your property is growing based on the $1 million valuation. So if there's a 5% increase, it's on $1 million. It's 5% of $1 million, not 5% of $100,000. So I think people don't take that into consideration, right? So if you're going to buy a stock and you put $100,000 on the stock, right? You're earning 5% of $100,000 or 10% of $1,000. It doesn't grow as quickly as when you're putting it on a house, where if it goes up 5%, it earns you a lot more money, right? Anyway, so I disagree with these numbers, first of all, but let's finish what he's saying.
Years. You're not going to sell it for that. To break even, dead money, and you had to put $100,000 down to do this. They're serving a master. They'll borrow money from the Bank of America, and then if they can get some more money, they'll have a little retirement account that funds Wall Street. This is a big game, bro. Rather than buying one house.
So retirement. Do you know how many people that I was door knocking? They bought the property in this, let's call it maybe it was in the 50s or the 60s, and they're retiring. This was door knocking back in the day. Do you know how much money they paid for a house worth $1.2 million now? $70,000. I think if they sold for even $1 million and only paid $70,000, even if they're incurring these taxes every year, I think it's a pretty good paycheck for them. I think they could live off of that retirement. What do you think?
Rent where you live and take that $100,000 and go buy a piece of real estate where other people live. I just don't need to own a home on the way up. I need to own assets that pay me on the way up. And once I have enough.
I do agree with that. Okay, so yes and no, right? Listen, at the end of the day, you need a place to live. And we talked about this in the last video. If you already know the area you're going to, like the amount of money you're paying for rent, you're just paying the interest to somebody else anyway. You're paying somebody else's mortgage. So if you can do this correctly, you could own your property, pull equity from your property and buy other properties. But if you don't want to do that, you can pay off your home, but that asset will continue to grow. So I'm a firm believer that you should own your home. I'm a firm believer in, if you're a realtor, you also should own a home. And why do I say that? Well, you need to know the process, right? You need to know what it's like to buy and sell and the maintenance fees and how things change in the market because you're a homeowner. How could you go to somebody, tell somebody to buy a house if you don't own one yourself? It's kind of counterintuitive, right?
Pay me on the way up. And once I have enough cash flow from the assets, then if I want to go buy a house or a watch or a car, I buy it out of the passive income.
Okay, so I got what he was saying that too. So why buy a house first and all that to buy passive income? Listen, he's right and wrong about certain things, right? Now, if you buy a property, remember, it's time in the market. It's not timing the market. If you own a property and what you're paying this, and instead of renting, and you could almost pay the same amount, let's be honest, like the rent, like it's not that much more to own and as to rent, relatively the same in this type of market. And if you're paying yourself that amount, remember, you're paying interest plus principal. At the end of the, say, 5 years too, remember your mortgage payments, the way we do in Canada, it's different than the States. So your principal decreases, which means the next time you negotiate your mortgage, your principal is less, which means your payments are going to be less. And the next 5 years is going to be less. And the next 5 years is going to be less. It's less and less and less. You will have more cash flow after the first 5 years. You can also, at that point, if you have more cash flow, don't be stupid with your money, you can also buy an investment property. Now, if you're a young kid and you're living at home and you have no desire to, I don't mean a young kid, but if you're younger, you're not married, you're not worried about owning a home, and you can live with your parents for a certain period of time, 100% listen to him right there and buy an investment property. Let that passive income, cash flow positive, try to make that cash flow positive, but let that cash flow help fund your own home. I would agree with that 100%. Why not, right? Not everybody wants to live with their parents until they're 40 years old, but that is what it is. But listen, I'm not saying that. Like, I bought my first investment property. I was 25 or 26 years old. I lived with my parents for a couple of years. I used that equity, and then Natalie and I built our matrimonial home. So yeah, I would agree with that too. I don't like the first part of his analysis. I don't agree with that. So guys, I like these videos. I always like getting other feedback. I want to know what your feedback is too. You know, this is me as being an investor, as well as a homeowner. When I'm talking to you, I'm talking from a place as not as a realtor, but as a real person who's living in this and actually doing this in a day-to-day basis. Be careful with the advice you take from everybody. It's like anything else, right? You can like a celebrity, you can like a politician, but you don't have to agree 100% with everything they say. Some of these guys make some good points. The first guy, not so much. But my point is, you got to take with a grain of salt. The other thing is, always go talk to people that know more than you. Talk to somebody, maybe mirror them. Ask them, somebody else who's bought properties. It could be anybody, and they bought investment properties. Talk to them, say, how did you do this? Maybe talk to your parents. Maybe say, hey, did you ever regret purchasing your property? We always go on social media, we try to see them as experts, but we have experts around us everywhere. You can talk to your lawyers, you can talk to mortgage brokers, you can talk to realtors, you can talk to insurance guys. It doesn't matter who, financial planners. But the idea is, like, before you jump into anything, don't just listen to what somebody tells you on social media. Don't listen to me, like just because I tell you to do something, or I don't tell people to do anything, but have a real conversation. You may not agree with everything I say, and I don't expect you to. That's the beauty of this. I always like people pushing back, and I say, but you can use my knowledge so you don't have to make the same mistakes that I made. And let's be honest, everybody makes mistakes. If you can learn from other people's mistakes without making them yourself, and listen, you're going to make your own mistakes and you're going to learn from them as well. But if you don't have to repeat the same mistakes over and over again, why would you? So do yourself a favor, right? When you hear a piece of content like this, talk to other people that are actually in the industry doing what these people are saying they're doing, and see if they're accurate. the second video we watched, he was pretty bang on. I would accept advice from him. It doesn't mean I'm going to agree with everything he says. It doesn't mean you're going to agree with everything I say. So that's basically what I would say. But I really like this forum. Thanks, Owen, for bringing these videos up. Guys, we always want to hear content like this. We'd love to hear from you. If there's other videos you want me to comment on and you like this forum, we continue to do this over and over again. If you're watching this on YouTube, we always ask, please like, subscribe, share. If you don't know where to watch these or listen to these, always go to my link tree, either on, I guess it's on my TikTok or it's on my Instagram. And you can click on there and you can listen to these wherever your podcasts are played. So again, thanks again for watching, and we'll see you next week for episode 100.